Welcome, everyone. I'm Angelo Robles, host of the Angelo Robles podcast and the founder at Family Office Association. Are you betting against the future, innovation, unstoppable progress? What's the consequences of not, you should think of it that way, of not allocating even 1 to 3%? Now, you're probably all wondering, like, what is Angelo talking about? Well, I'm talking about crypto assets. And many of you know that I've been very going down a deep rabbit hole over about the last 12 months. So we really have a great guest on today. But I want to set that stage because we have people that are very early stage, some sitting on the fence, some in the middle, and some highly sophisticated. I want to read something that I'm going to mix in probably some of my own words from Raoul Paul, who's a great thinker and thought leader as a macro person in the community to help set the stage. If you don't see by now that the tokenization of everything is the biggest thing we have ever seen and ever will see, I can't help you much. It dwarfs all other opportunities. Listen to this, from a risk reward over time. Web3 is something few yet understand that will change business forever. I agree with Raoul. This does not make traditional investments nullified. Absolutely not. But it makes them much less interesting from a risk-reward perspective. You can bet against the people active in this community, including Arca, Jeff, who we have on today, including Soros's family office, Tiger, More Capital, Tudor, Brevin Howard, Balzani. The list grows every day. So I don't know. Maybe they're the fools. I probably don't think so. So today we're going to cover crypto 0 to 100 miles an hour in 90 minutes. It features an old friend of mine who's one of the big thought leaders in the community, Jeff Dorman, CIO of Arca. Jeff, welcome to the show.
Thank you. Thanks for having me back.
It's a pleasure. Let's get to it. Are stable coins really as stable as we've been led to believe?
I mean, look, they are from a price standpoint so far. Now, that doesn't necessarily mean it's a look into the future. And there's a lot of different types of stable coins. So it depends on which ones you're talking about. There have been some experimental ones that have basically gone to zero within 3 days. But for the ones that are largely being used in the ecosystem today, which is Tether, USDC, and maybe some smaller ones like the Gemini dollar, Paxos's dollar, as well as some decentralized ones like UST and DAI, they have been fairly stable. And I think they will likely continue to be stable, not necessarily because of how they're constructed. In some cases, I think it is, but really because like most currency instruments, it does become a faith issue, and there's enough people using it and treating it as a dollar that inevitably it becomes one. There are certainly risks ahead, but I like to look at what is today more so than trying to predict black swan events. And what it is today is a very useful and a quite common digital asset to be part of this ecosystem, and for anyone who has sent bank wires or has used ACH or have used the alternatives, try to use a stable coin. Watch how fast it is. Watch how easy it is. Watch how much better it really is. And you'll realize why people are making such a big push to make this a standard, even if maybe it's too early to 100% predict that it will be forever.
And maybe, Jeff, for those that are newer to the verbiage we're using, we want to also bring it down a little bit to them. And that includes even billionaires that I know that are just beginning to, after like 12, 13 years, to wrap their arms around some of the things we're talking about. So if you don't mind, give a straightforward definition of what a stable coin is.
Sure. And like most things in the digital asset market, somebody created the term and everyone else just adopted it, right? There is no reason we're calling it a stable coin other than that's the vernacular that has caught on. If you actually listen to Gary Gensler now at the SEC, he is trying very hard to call these stable value coins rather than stable coins. He's trying to change the narrative to basically fit it within the SEC's jurisdiction of money markets so that they can regulate them, right? So there is still a debate under what these should be called. But in essence, what a stable coin is let's back up for a second, right? What are digital assets? Digital assets are literally just a way to transfer assets over the internet, right? So if you think about what the internet did for communication, the internet made communication boundaryless, free, instantaneous, right? You can send in a 1,000-page email in 4 seconds. You can do a video call like this that I'm sure is transcending multiple countries. That's what the internet did for communication. What blockchain is doing is the same thing for asset transfer. You now have assets that can move global, boundaryless, free, instantaneous. Well, that's great, except the first forms of digital assets like Bitcoin and Ethereum and now other pass-through tokens and asset-backed tokens inherently are volatile, right? They're basically equity-like instruments or currencies of emerging markets that have high fluctuations relative to what we spend most of our money on, which is, here in the US, obviously dollars, but, euros, yens, et cetera. So all stablecoins are is an attempt to create the same blockchain functionality of instantaneous, free, global transmittance, but doing it in something that, at least in your base currency of dollars or yen or euros, is not going to change. And for the most part, they have been successful. Now, there's a lot of experimentation going on. Some are better than others, but the few that have risen to the top of the pack have done it quite well. They have found a way to create an instrument that mostly maintains its peg to the dollar and essentially allows you to take zero base currency risk while still transacting in the digital asset market.
And we'll get a little bit to monetizing from an income perspective, which I'm going to assume probably half my audience has no idea of. We'll get to that in DeFi a little bit later. Many believe, or some believe, that Tether, one of the big two, quote unquote, stable coins, could damage. I've even heard some people say destroy the entire cryptocurrency ecosystem. Is this FUD, and why?
So, I mean, look, just for some numbers here. A year ago, let's go back to the beginning of 2020. The total dollar amount of stable coins in existence was about $6 billion. 2 years later, it's now well over $130 billion combined across all the different stable coins. And Tether is basically 2/3 of that at about $75 billion. So stable coins have gotten a lot of interest in the last year and a half just because of how quickly they have risen, right? I mean, this went from a niche side project that nobody cared about to all of a sudden being on the docket for every government official around the world because of their sheer size. I think the fallacy is assuming that the digital asset market is going to be affected by stablecoins. In reality, the risk is what stablecoins might do for traditional markets, because the way these stablecoins are operating for the most part is they're really just unregulated money markets. Somebody gives $1 million to one of the stablecoin providers. They give you back a stablecoin in return that is transferable, a blockchain-based instrument that's easy to maneuver and transfer. And that $1 million has to go somewhere. Well, obviously, they're not just putting it in a pile of cash, Scrooge McDuck style in a vault. They're not putting it in a bank necessarily, because it's notoriously difficult to bank. The pipes between traditional banks and brokerages and digital assets are still not very sound. It's very difficult to just park money in a bank. Obviously, you will earn zero return if you do that as well. So what do? You do the same thing that money markets do. You start buying commercial paper. You start doing some very short-term AAA type loans. So in essence, it's not that it's a risk to the digital asset market. It's actually the opposite, is that these things have gotten so big so fast that they are now giant creditors of the world with commercial paper. And if we see a traditional market meltdown, something like we saw in 2008, where a money market might break the buck, the digital asset market is actually going to be a major player in that. So I think the reason that regulators around the world are so concerned is not because they care about the fate of the digital asset market. And this is still only a $2 trillion industry that's been around for essentially a decade. It's what the digital asset market might mean for traditional markets. And as a result, I think you're going to see real regulation at the stablecoin level before you see anything else. And I think it matters. What I don't think people have right is that Tether is some mysterious offshore unregulated thing that is different than every other stablecoin. The reality is, there's multiple stable coins. They're all effectively operating the same way, which is unregulated, buying commercial paper, very opaque in terms of what they're doing. Tether gets a bad rap for a couple of reasons. One is it's the first and it's the biggest. Two is they got in trouble 4 years ago for something that they've admitted to 2 years ago. And you could argue whether or not they're really to blame, or if it's really the blame of the fact that banks won't let them do what they would traditionally do. So they had no choice but to find other ways to park that money. Regardless, they definitely made mistakes and they've paid for it dearly in terms of reputation. But the reality is, if you looked at a snapshot today, Tether, USDC, Paxos, Gemini Dollar, they're all the same. These are unregulated money markets that are very non-transparent with what they own. And there's risks to traditional markets as a result. So I think that will be a huge focus of the governments around the world over the next 6 to 12 months.
Yeah, that appears very obvious. Until we get to some of the lending and staking that will bring the subject back in from a different perspective a little later. One last question, perhaps a little more specific to Tether, but you could argue broadly in the stablecoin ecosystem. Some Tether critics fear that the real use is to keep the price of Bitcoin high. Is this true?
Well, there's a reason there's a very high correlation between so to back up for a second, Tether effectively operates no different than an ETF in the sense that there's creations and redeems. The more people put money in, Tether is created. When Tether is created, it goes into the ecosystem, and therefore most likely it's going to be used to buy digital assets, right? There's seemingly no real reason to create a stable coin unless you're trying to move money from the traditional banking system into digital assets as an on-ramp, and then use it to purchase digital assets, right? There's not a lot of other use cases for stablecoins other than use in the digital asset ecosystem. So as a result, there's a naturally high correlation between the size of the stablecoin market, especially Tether, and the price of digital assets. What people are trying to say is that that is a causation and not a correlation, saying that this Tether is being printed out of thin air with no actual money coming in, and they're using it just to print it out of thin air and then buy Bitcoin with it to pump up the price. There's absolutely no factual statements around this. It very well could be true, just like a lot of things could be true, but nothing has been proven to illustrate that this is what's happening. But because of this strong correlation between the growth of stablecoin outstanding and the price of digital assets, people are jumping to that conclusion. And again, it comes back to the lack of transparency, not specific to Tether, but specific to every single stablecoin that is in existence, that is allowing people to jump to these conclusions. What I will say is, Arca is a good example. Arca is as kosher and proper as you could be in this space, right? We are an SEC registered firm on our digital asset lab side. We have a huge compliance regulatory focus at Arca. We've had no less than 10 investors in our funds who have been shut down by their brokerage and bank accounts, sending money into our private fund vehicles because we're listed as a digital asset company. So just to help illustrate how separate these bank and brokerage world is from the digital asset world, is it is hard to get money into this ecosystem and out of this ecosystem, which is why stablecoins have become the preferred on-ramp for anybody trying to get money into the system. So a lot of what you see with these stablecoins kind of sitting in the middle from money that started in banks and brokerages and money that ends up in Bitcoin or other digital assets, they're becoming the necessary middleman, and there should be scrutiny on that. But a lot of the fear that has been created around what they're doing is not because there's some unscrupulous bad actor trying to hide money or trying to print stablecoins out of thin air to pump up the market. It's because there's literally no choice. You can't take that money that's parked in these stablecoin issuers and do anything with it. The banks won't accept it. The brokerages won't accept it. It's not like they can just set up any sort of an account to put this money in. So we are still sitting in this uncertain ecosystem where, as a result, as we all know, whenever you don't have 100% clarity of what's going on, markets like to jump to conclusions.
For sure. And we'll get into some of that from a regulatory perspective. And once that gets more clear, and it looks like it's happening pretty quick, good or bad, as well as other factors, we'll get to the ESG element and all that. And then institutions start to come in. That could be a whole different dynamic. So in today's discussion, hopefully it might even be a little longer than 90 minutes. We have a lot of things to cover. And for really, I think the first time ever with any guest, we'll actually even get into some specific cryptocurrency, go back and forth on its use purpose. Is it, quote unquote, an opportunity to be part of a portfolio? So stay tuned. We're going to cover a lot. Jeff, you've been investing for years at Merrill Lynch, at Citadel Securities. Are crypto assets way much more than Bitcoin, if that's all what you think? Is this the greatest asymmetrical investment opportunity that you've ever seen?
Yeah, I think so. And it's funny. There's a lot of taxonomy issues right now in this asset class. For instance, you're using the term crypto assets. I tend to use digital assets. Neither is right nor wrong. But the issue is, because Bitcoin was the first one, and Bitcoin is a cryptocurrency, right? Its sole purpose is to try to be a store of value or a medium of exchange.
Right.
A lot of people entering the space are just like, well, what about these other Bitcoins? What about these other cryptocurrencies? And that was maybe true 4 or 5 years ago. Most of the digital assets that were created were copycats of Bitcoin. But then you had smart contract protocols like Ethereum and a lot of competitors of Ethereum. Then you had asset-backed tokens. Then you had pass-through tokens. You now have different sectors. You have gaming, NFTs, Web 3.0, DeFi. This asset class is expanding so much that you really can't just lump it all into cryptocurrency or crypto assets. You really have to start thinking about this with a broader lens. And in some ways, my co-founder at Arca, and who actually was the co-founder of Wisdom Tree as well, the large ETF company, but my co-founder, Rain Steinberg, made a really astute point a few months ago in an article he wrote where he said, I'm not even sure digital assets are an asset class anymore. It might just be the technology that underpins all asset classes, meaning every single equity security is effectively going to be wrapped in a digital asset one day. Every bond, every real estate property, every commodity, every currency. And there's some truth to that in the sense that most of these digital assets now are so different. The inputs to their success and failure have nothing to do with each other. The outputs of the token economics or the token accrual mechanism have nothing to do with each other. So when I think about this space, then absolutely, this is the greatest asymmetry we've ever seen, because these digital assets are starting with quicker starting points and lower barriers to entry than anything we've ever seen. They're becoming liquid much faster, right? We're not waiting 7 to 10 years from a private company to go liquid. They're tapping into retail immediately. They're tapping into global fragmented markets immediately. And while there's going to be a lot of failures, and there certainly have been a lot of failures, when you do your research and you find the tokens that are driven by good management teams in good sectors of the economy where there's a real reason for a digital asset to exist, and they get the alignment right where all of the stakeholders who are backing this project, from founders to developers to volunteers to customers, et cetera, are all aligned in the same way to see the growth of the project, that's when you start to see these 100x returns in 2 years. And for every Dogecoin or meme coin out there that looks no different than like a GameStop or an AMC, where it's up for no reason, there's 100 real companies and projects that are up for real reasons. They have real traction. They have real user growth. They're solving a real purpose. And in a lot of cases, they have real cash flows and revenues that accrue directly to token holders. So once you start to open your mind a little bit about what this asset class is, that it's not just cryptocurrency, it's not just Bitcoin, there's all these different types of tokens. And obviously it sounds like we're going to get into a few specifics later in the hour as well, but all of these different tokens are different. And when you find good ones, yeah, it is the best asymmetry we've ever seen.
Yeah, I'm going to take what you said, ask you a question, then I'm going to get back to the issue that I would highly recommend to family offices, principals, CIOs, institutional investors, and really investors in general. This is all going to tie together, promise me, but Jeff queued it up really good. In 10 years, will digital assets, you're proud of me, Jeff, including cryptocurrencies, DeFi, NFTs, the upcoming social tokens that I think will be the next big thing, well, it's right now about 2.5 trillion. Will it be $100 trillion asset class? I've been thinking about this for a couple of days, and I actually think I may be way too conservative.
Yeah, I mean, as soon as you threw out the 100 trillion number, the first thing I thought of was that's way too low. And again, you have to do the math on whether or not this really is an asset class or whether it does underpin all asset classes. Right. Because gold is 10 trillion. Okay, so let's say Bitcoin is eventually gold 2.0. Okay, that should easily be 10 trillion. Well, what the equity market is, what, 70 trillion? Well, if you have all, okay, so if you have, well, U.S. equity, the global equities are probably more. So if you think about all the different types of equity-like properties that you can wrap inside of a digital asset, then yeah, that could easily be 50 to 100 trillion itself. And then take the fixed income market, right? We're talking hundreds of trillions. Take real estate. Basically, you look at all the different ways that you can jam something into a digital asset wrapper, and it's quite amazing. Like, so I'll give you a quick example. One of the things that digital assets have done is they've basically combined loyalty reward cards with quasi equity. And what I mean by that is, let's take an example of Amazon. Amazon has your Prime membership, right? If you're a Prime member, you get all the benefits of Amazon. You get, you probably bought it because it was just to get free shipping. And then eventually they tacked on all these other customer benefits like Whole Foods discounts, free movies, free music, et cetera. But you get absolutely no financial interest in Amazon's growth. You just get the benefits of being an Amazon stakeholder or customer. Conversely, if you're an Amazon shareholder, you're getting all the growth of the company, but you may not even be a customer if you don't want to be, right? There's no reason that Venn diagram has to be connected. What digital assets are doing is basically forcing you to be both. You have to be a customer or a stakeholder in the ecosystem. And also you're getting the quasi equity of growth of the company through revenue and cash flow, dividends and things like that. So what you're doing is you're immediately pushing that Venn diagram together, and you're creating incentives to allow these companies to grow. So what does that mean? Well, it means that Starbucks is going to have a token one day, and they're going to combine their loyalty with their equity. It means that United Airlines and Delta are going to have tokens. It means your local bodega around the corner is going to have a token. It means your barbershop's going to have a token, your gym, everything that you interact with, that you get some form of actual usage and utility out of, they're going to have a token. You know who else is going to have a token? Municipalities. You're not going to see revenue bonds and go bonds anymore. You're going to see tokens that build the infrastructure. And if you're a token holder, maybe you get discounts on the subway, or maybe you get private access to the parks. Every university is going to have a token. Instead of having random donors and random boosters, you're going to have a token that can be used for tuition. And if you decide not to go to that college, you sell it to someone else who does. So what this means is when you talk about the growth of digital assets, it's going to be tenfold what we're seeing in the equity and debt markets right now, because it's going to be more inclusive. And $100 trillion all of a sudden starts to sound like a really small number.
Yeah, I mean, and that's the big point. More so to those that are, this is new, or giving them a fire hose, or those that are on the fence. And I completely understand is, again, it's 2.5 trillion. Who knows? I said 10 years, 100 trillion. And I meant that to be a little tongue in cheek, like it's little. So this may grow 50 to 100 to more X, and you're going to stay on the sidelines and miss out. Now, here's a bigger point that I'm going to take a little bit of what Jeff said, and we're going to get to NFTs, and this will all kind of play into that a little bit later. You're going to have a hard time functioning in society. Let's even forget the investment opportunity that you may miss out on. In terms of looking 5 or 10 years out, central bank digital currencies, having wallets, the massive rise of NFTs, which is a hell of a lot more than digital art. Actually, basically what Jeff was just talking about is going to be kind of NFT / blockchain. We're going to get to that a little later. So now let me reposition that. What is going to happen to my peeps, family offices, the CIOs that are probably a little on the older side, and this is coming at them really quick. They're just getting their arms wrapped around maybe putting a little bit into Bitcoin. And we're talking so much more than that. I mean, I'm afraid that within 5 years, this whole, it may pass you by. Like, this is for the security of your job, for opportunities moving forward. And a lot of younger people are highly fluid in this. This is going to be massive. Unless I'm just, even if I'm half wrong, it's going to be massive. I mean, what would you tell those that are a little bit more traditional in the family office? And let's throw in the institutional world. We'll get to them a little bit later on the regulatory and ESG front that does impact them. I mean, if I was them, just your job security, that I would be really on top of this. What do you think, Jeff?
I think first and foremost, everyone has to be more open-minded, right? We are naturally skeptics in terms of investing, right? We hear something new. I mean, myself included, almost everybody I know, right? The first time we heard about Bitcoin, we laughed. We said, that's a joke. And then eventually we said, oh, that might be interesting for someone else, but it's not for me. And then eventually, maybe half the people decide, this is kind of interesting. But the point is, if you are immediately looking for reasons to discredit what has happened, you're going to miss out on some of the good reasons and good points that people like ourselves and you are making about why this is really going to be a growth industry. So step one is being open-minded, understanding why this technology and why the different asset classes within this technology are really growing and are being impactful. We often do calls with our LPs and prospective LPs. We'll talk for an hour and a half and not even mention Bitcoin. I mean, that's how diverse this asset class has gotten. Bitcoin, sure. How many people really care about gold? Not that many, right? Not that many people are going to care about Bitcoin ultimately either, relative to the other ideas that are coming about in the space, like DeFi, like NFTs, like social tokens, et cetera. So there is going to be a big educational journey if you open your mind and are willing to accept it. The other thing is I would point to every time we have seen rationales for why an investor is not into digital assets yet. A year ago or 2 years ago, it was largely, it's fraud, I don't understand it, it's speculative. Really now, the biggest hurdles we hear is, well, there's no regulatory clarity and I'm concerned about stablecoins. Well, both of those are going to be solved, right? Regulatory clarity is inevitable. For the most part, even though a lot of people in the digital asset world are very libertarian or anti-government in some way, the reality is, one, the regulation is coming no matter what, and two, the regulators are actually doing a good job in the sense that they're not rushing it, right? This asset class is evolving so fast that if they were to put wide sweeping regulations in place, they'd be obsolete within 3 months. So what they're doing is they're calling the Arcas of the world, they're calling the Coinbases of the world, they're gathering information and they're trying to figure out what fits within the current rules and regulations that they have and what doesn't that requires new laws. So what's going to happen is inevitably they're going to try to jam as much as they can into the existing laws. And don't forget, most of these laws were 1930, 1940. So obviously they're not exactly the most up to date, but they're going to try to figure out as much as they can that fits within the existing law and jam it in. And you're going to see different regulatory bodies fighting for control. You're seeing the SEC and the CFTC fight right now for that control. And then they're going to create new laws that actually govern this asset class more correctly. And that's going to take years, right? It takes a long time for laws to get passed in the United States and in most mature countries and jurisdictions. So it's going to take some time. But once that happens, it's going to open up the floodgates to trillions of dollars who have been sitting on the edge of the pool with their feet in, just waiting for that clarity. So that's number one. Two is, again, the stablecoins. Stablecoins are going to be regulated. It's not going to be a takedown of Tether. It's going to be a regulated asset class, in which case those who comply with the laws are going to grow faster than others, because the reality is these are all perfect substitutes. If Tether went away tomorrow, nobody would care. They would just all move to USDC or somewhere else. In fact, this entire asset class has perfect substitutes. Every single exchange, every single asset manager, every single lending and borrowing platform, every stablecoin, they all have perfect substitutes. So, if you've ever taken an economics class, you know that you're not going to have much of an impact when there's perfect substitutes. So anyway, the point is, the questions that we're getting now are not about, are these digital assets real? Is this technology real? Is this a bubble? The questions are now, can we solve these other big issues? And if we do, it's off to the races. So I think you absolutely have to start developing that strategy now and learn about all these different types of digital assets, because the hangups that still exist are going to get cleared up.
It's very natural, and it happens to all of us, and you hinted at it, especially as we might age and have some success in our career. We do tend to acre. We do tend to have confirmation biases, and you have to look at it with Bayesian analysis in terms of kind of like playing poker. As new information comes in, you need to adapt, and sometimes you need to adapt quickly. I elected to put in, again, ballpark 15, 16 months ago, a couple of hundred hours of diligence. And then looking back, I'm like, I did too much. I took too long. I missed out on opportunities doing that. And some of the information is changing so quickly that what I put in dedicating, building up my knowledge last summer into early fall, some of that became dated so quick. Which goes to one of my points I'm going to give. I was at a single family office that I know well. I know the principal and I know the executives. And basically I was talking to them about, you've already done research. You're kind of on the fence, although I don't get why. Why don't you at least, you're used to being an LP in funds. You're probably getting some exposure to this, digital asset ecosystem, whether you know it or not. But they were looking at being a little bit more directly involved. The principal comes in. And, hey, Angelo, what's up? All that good stuff. What's going on here? I'm trying to talk to them about, crypto and digital. And the principal, the one who, again, is most direct with the money, is like, what the hell? We have 20, 30% in cash, fixed income, and gold. Net of inflation, it's doing garbage. Yeah, would I like to know this and understand it better? And I will. But in the meantime, I'm the boss. Here's my decision. We're going to put 1% of our assets by repositioning out of underperforming assets, and we'll figure it out later, whether we want to scale back or grow. In that case, I'll tell you what they did. With institutional level purchase and custody, they did an equal amount in Bitcoin, Ethereum, and Solana. And the principal brought up a great point that I remember to this day. It's going to be 1%. If it goes to nothing, what it's already invested in has been effectively not working out too well. My asymmetrical opportunity is so great, I'm mitigating my risk by controlling for now, which may go up, the percentage of my allocation that I'm putting in. It's amazing when the person is directly with their own capital, how quickly they can make a decision.
Well, Angela, if I can, I'll jump in here for a second. The other thing too, in terms of just how early we are, and you know, I don't like to use the baseball analogy of what inning we're in across the whole market, because again, there's different pockets of this asset class or this technology that are in different stages or different innings. But all the firms you mentioned that were getting in earlier, you're talking about Raul Paul and Tiger and Balyasny and Brevin Howard, they're all macro funds, right?
Right.
The growth equity funds are not in this space yet. I mean, we created at Arca, we started our fund almost 4 years ago to basically sit in the middle between your venture capital and your kind of macro traders. And we were like, this is a great asset class. We're gonna, you know, we're one of only a handful of companies that are focused on this liquid, you know, equity-like true fundamental valuation space, fully expecting that the oak trees and the Blackstones and the, you know, true value investors would be there soon. And 4 years later, they're not even off ground. You know, they haven't even gotten started yet. They're maybe still discussing Bitcoin. So we effectively 4 years later and almost $1 billion of assets later, we still have zero competition in the space that we operate in, which is in that liquid fundamental avenue. So just to provide more color there about why there should be some exposure is there's pockets of this asset class and this technology that literally nobody's even looking at yet, right? They're just getting over Bitcoin and stable coins and haven't gotten to, you know, Axie Infinity, which is doing 3 billion of revenue, or Uniswap and
Doing a lot of
Sushi Swap.
revenue.
Yeah, or Uniswap and Sushi Swap that are doing 1 billion of revenue. I mean, there's huge opportunities now in this space of real revenue producing, cash flow producing growth equity like companies that has zero eyeballs on them. So, you know, in terms of thinking about that 1 to 3% allocation or whatever that allocation is, it is incredibly early when you move beyond just Bitcoin.
Uh, I mean, we're going to get to where a lot of larger investors, like I said earlier, they're used to the fund structure. We're used to there's a GP, we become an LP. This is complicated. They're the experts. What's this custody thing? It seems complicated. I could get hacked. I become an LP. I don't have to worry about it. I promise we'll get to some of that. But initially, and a lot of people that are watching eventually on YouTube may be interested investors, but not meant to be an LP. So for them, it's how do I allocate smartly to crypto assets? Like, where do they start? How do they invest? And how do they custody? I mean, they could go on an online exchange on a computer or their phone. If they're a larger investor, they could do over the counter, probably recommended. And then it comes down a little bit to, I mean, and you know, Jeff, I promise I get asked these from family offices. Do I just go on whatever, crypto.com, FTX, Coinbase, and do I buy? I'm like, well, if you want to feel like you have a little bit of a stake in something and we're talking small amounts of money so you could get a little more experienced, I could be down with that. But if you're telling me it's, and it means different things to different people, an amount that is, I don't know, maybe it's 50,000 to some, 100,000 to others, like I'm like, you're kidding me. Like, you're not just going to leave that on your phone or computer. You're going to be your own risk. It's a bearer asset. You're probably going to get cyber attacked. And that starts to scare them. And then that goes into the whole issue of how do I purchase? How do I safely secure? Angelo, I'm not going to learn about air-gapped hardware wallets. So I'm like, well, maybe you should. I learned about them. So how would you, if you were recommending to a friend that wanted to understand it and get involved in some of the things that we spoke about and are going to speak about, how would you recommend they get started?
Sure. And, you know, there is a giant educational journey that you have to be willing to accept if you get into this space. But the reality is it's not that different than most things you do in life, right? I mean, you know, you can go back 20 years ago when, you know, how many, you get to an airport and there'd be 50 new kiosks that most people have never seen where you just swipe your credit card and get your ticket. Meanwhile, there's 200 people in line waiting to talk to a ticket agent, and all they do is walk you over to the kiosk and use it for you, right? So there's going to be middlemen who do it for you for a while, and then eventually you're going to be like, you know what, I can just go to the kiosk myself and do it myself because it's not that hard. The same thing will happen here, where in the beginning you'll use the middlemen, right? You'll use the FTXs, you'll use the Coinbases, you'll use the wallet providers, and then eventually you'll be like, you know what, I can figure out how to self custody, I can figure out how to send the assets myself. So a good way to get started is to think of this not as an investment at first, but as a utility. You know, the first thing I did in terms of learning how to use an air-gapped wallet was I set up accounts for all my nieces and nephews, and I just put like $50 in every year for their birthdays. And I'm like, okay, well, now I have to learn how do I buy Bitcoin? How do I send it? If something went wrong with the $50, it wasn't going to change my life, obviously. So, but as a result of doing it multiple times, I was like, okay, this actually isn't that hard. And then we figured out ways to do it at an institutional level so that we could do it with, you know, as a fiduciary of investor capital. And again, we set up processes and procedures and learned how to do it in that capacity. So to start with, you have to just be willing to put a little bit of money in there and play around with it. I was talking to an incredibly smart credit investor who I'd worked with, over the last 2 decades, and it was actually his wife who learned way faster than he did because she was like, I just want to figure it out for the kids, and just started moving assets around. We just buy a little Bitcoin, bought a little USDC, sent it around, swapped it on a decentralized exchange, just to figure out how it all works. And we see it at the LP level as well. We have multiple LPs at Arca in our various funds who would throw a very small amount into our funds just to give them a reason to actually read the things we write and learn more about what's going on. So it doesn't mean that right away you have to come up with a strategy to put 3% of your assets into a bearer asset and hold it yourself. But it does mean that the individuals at the family offices should probably play around with their own money while developing a more institutional strategy for the family office itself. And like I said, like anything, it's actually not that hard once you start doing it. It's just, it takes an interest and an effort. I'll give you an example. We just hired someone in our trade ops team at Arca who spent 15 years at Merrill Lynch, never touched a digital asset before coming to Arca. Within 6 months, he's the most knowledgeable person in our fund right now in terms of how to move assets, how to interact with DeFi. It's not because he was smarter than anyone. It's because he was really interested in it. He had the professional background from Merrill Lynch. He had the operations background from Merrill Lynch. He learned the digital assets in 6 months because he decided that that was what he wanted to learn and that's what he cared about. So it is very overcomable, the educational gap. It's just a level of deciding you're going to do it.
For sure. And I use myself as that example. So in terms of what you're describing, I completely agree, although it's a little scary with smaller dollar amounts, understanding how the exchanges work, understanding being very careful and secure with your phone, then kind of getting experience with air-gapped hardware wallets, I think are everything. An executive, I don't care how old you are, if you're going to be advising a principal, you should build up a level of experiences and a foundation. Now, yes, for larger scale investors, they want to be an owner of, and I mentioned 3 before, whatever, Bitcoin, Ethereum, and Solana, probably doing over the counter and getting professional institutional level custody. I know the maximalists are going to cringe, the libertarians will cringe, and I hear them. But I'm saying for the majority of people that are in it from an asset class and investment perspective at the level of a family office level, that simply is logically going to be the way for them to go. Although it seems a little bit old and dated, let's still talk about some of the risk. And because people may be familiar with Bitcoin, we'll stay a little bit on that. So in my opinion, you have multiple. You have regulatory that I think is becoming a notch more clear every day. You have energy consumption that may be more impactful to ESG-centric family offices and institutional investors. And yeah, you have things, if you really want to plan it out, black swans, what happens if the electrical grid goes down, what happens if Satoshi, quote unquote, appears, and how about Elon tweets? We probably don't have time to jump into all of them. Maybe you want to pick one or two and talk a little bit about it.
Well, sure. I can just the Elon Musk and Satoshi thing is easy to cover because I think when Elon Musk tweets and moves markets, that's a much more a reflection on society than it is on the asset class itself, right? We tend to personify and glorify individuals, whether it's Kim Kardashian or LeBron James or whoever. That has nothing to do with the asset class. That has to do with an individual that people seem to care about who just happens to be talking about a small cap industry. Therefore, it's much easier to move. So I can dismiss stuff like that. I mean, that does add volatility to tokens that most likely nobody should be in the first place, but it doesn't really have an impact on the overall asset class.
Except for me.
I mean, but that's a speculative bet. Knowing it's a speculative bet, that's not an investment, right? That's very different. And I think if Satoshi was ever revealed, that would absolutely damage the brand of Bitcoin, right? The brand of Bitcoin it's decentralized, it's pseudonymous. Nobody knows how it started. It's a little bit of a almost religious in the sense that nobody really knows how it got started. If all of a sudden Satoshi was revealed, that would definitely hurt Bitcoin. But I think we're past the point where Bitcoin dominates the entire market. Bitcoin would go down, and like I said, there's perfect substitutes. Something else would pop up, and the market would move on. So those are easy to dispel in terms of real risks or fears. I think the ESG point I'd spend a little bit more time on. there's been a lot of talk about the E in ESG, the environmental impact of Bitcoin. And there's like most things, there's a lot of nuance in that, for just like everything in life, there's going to be negative and positive externalities when you have something new. There are certainly some negative externalities with regard to Bitcoin's environmental impact. There's also a lot of positive externalities in the sense that this is democratizing finance for a whole host of people in different countries. Regardless of where you stand on that, what people seem to have lost is that there's three letters in ESG. It's not just environmental. There's also social and governance. From a social standpoint, I think what digital assets are doing is the greatest societal instrument we've ever created. And I'll give you a couple examples, right? Let's look at Airbnb and DoorDash. Airbnb and DoorDash created $100 billion each of market cap for basically a handful of early stage investors. But those two companies would not have existed if it wasn't for regular people, right? So for Airbnb's standpoint, it's people who own houses and people who vacation, right? That's the majority of the world. For DoorDash, it's people who eat food, people who cook food, people who ride bikes and deliver food. Again, that's a majority of the world. None of these people who made these companies successful benefited financially in any way, shape, or form from the growth of those two companies. Now, if instead of having an equity backing, those had a digital asset where instead of selling it to a bunch of early stage VCs and keeping most for the founders, the tokens were distributed to all of the stakeholders, the bike riders, the cooks, the people who eat food, the people who own houses, you would have had democratization of that wealth right off the bat, and you would not see these huge wealth equality gaps that we see today. So from a societal standpoint, it really is a benefit to have digital assets and to disperse to all of the people in the ecosystem, not just a handful of early stage investors. And you can go down the list. I mean, again, thinking about Venn diagrams, like how many McDonald's shareholders actually shop at McDonald's? How many McDonald's customers actually own shares? You can look at someone like myself. I've been a Starbucks shareholder for over 20 years. I literally have never had a cup of coffee in my life. The only time I've ever stepped foot in a Starbucks is to use their bathroom or to steal their Wi-Fi. And as a result, I get zero. I give zero economic benefit in any way to Starbucks. They give me zero utility. We have this marriage that honestly should have fallen apart 20 years ago. So what this is doing from a societal standpoint is it's creating these coordination mechanisms and these incentive mechanisms to better align people. When I spend my Saturday with my kids and my wife, I'd say 90% of what we do on a typical Saturday, I have no economic interest in. That's crazy, right? I should have an economic interest in the restaurants we go to, in the climbing gyms that we go to, in the parks that we play soccer and baseball in. I think that's where we're headed from a societal standpoint. I think that's going to be incredibly positive. From a governance standpoint, that's exactly what digital assets were built to solve, right? Instead of 5 old white guys in a boardroom making all of the decisions, and you as an equity holder pretending that you have some real claim on anything, even though the reality is you only have a claim if there's a bankruptcy. The rest of the time, you're just at the mercy of a CEO and their decisions and the board, who most often is in bed with the CEO to begin with. You have no real claim or no vote. You're just at the mercy of a couple of rich old dudes making decisions. Well, now from a digital asset standpoint, you have real governance. Not every token is designed this way, but a lot of them are designed in a way that the more tokens you own, the more votes you have. The more votes you have, the more you get to steer and impact what that company or project does in terms of how they spend their money, who they employ, what charities they give to, all these other factors that are important from a governance standpoint. Arca, actually on our website, if you go to it, ar.ca, we wrote a white paper a few months ago called a GSE, not ESG, focusing on the governance and societal aspects of digital assets. So I think that's a huge, huge component that is really overlooked and misrepresented by a lot of people who are fighting this environmental issue. And I would encourage almost everybody who's thinking about investing or interacting in digital assets to read that white paper we created, and or just start thinking about what this technology can really do in terms of positive externalities for the world.
For sure. There are thousands of digital asset organizations with cryptocurrencies. Like I said a little earlier, I've never really, other than maybe Bitcoin, have even just mentioned a couple and gotten feedback. So we mentioned 3 already so far, Bitcoin, Ethereum, and Solana. I'm going to make the assumption there's a little bit of a thesis and framework around Bitcoin and Ethereum, so we won't spend too much time on that. But talk a little bit about Solana. It came from nowhere, and it's become a darling, I guess you could say, of the community. I wish I got it in January. Talk a little bit about it, and is it a threat to Ethereum?
Well, Solana's been a great investment. It hasn't necessarily been a great product yet, and it's important to separate those two. There is a lot of different types of digital assets to start with. Maybe we'll back up for a second, right? Bitcoin is a cryptocurrency. There's plenty of other competitors to Bitcoin, whether that's Ripple, Stellar, Dogecoin, et cetera. Most of them are going to be zeros, other than just being fun to trade. But Bitcoin, for all intents and purposes, has won the cryptocurrency race. You could also put stable coins in that cryptocurrency discussion in terms of just something that has no intrinsic value. It's just meant to be sent, to and from as a medium of exchange, or in Bitcoin's case, a store of value. Ethereum and Solana are what are called smart contract protocols. The best analogy for these, and I test a lot of my analogies out on my 73-year-old parents to see if they make sense. But the best analogy for smart contract platforms is really the iOS App Store or the Android ecosystem. It's basically a technology that allows every other company in the world to build on it, right? So the iOS App Store was innovative, but it meant nothing until all these different apps decided to build an app in the App Store, right? You have your Nike apps, you have your Amazon apps, you have your banking apps, your gaming apps, et cetera. Then Android came along. And what happened? Well, all these companies, at first, they had to make a decision. Do I build on iOS or do I build on Android? And then eventually they said, well, this is stupid. Why don't we just build versions for both? Well, Ethereum and Solana are basically the Android and the iOS right now, where almost everything to date has been built on Ethereum. It was first, it had the most activity, the most developers, the most applications. Well, now there's a lot of competitors. There's Solana, there's Terra Luna, there's Avalanche, there's Algorand, there's Phantom. All of these are developing different ecosystems in which companies and developers can build applications on. Right now, because there's actually a pretty big lift in terms of learning the code to build in these different environments. They're very separate. You don't really have a lot of Ethereum apps that are also on Solana. You don't have a lot of Solana apps that are also on Ethereum. One day, it's probably not going to matter. You're not going to care what chain or blockchain protocol you're using. Ultimately, every application you might want to use, from a game to a banking application to a sports betting app, will be across these different chains. In terms of usage, though, I mean, Ethereum is still the clear leader. There's $163 billion of what's called TVL, total value locked on Ethereum. Right. That's basically just a fancy word for deposits. There's $163 billion that have been deposited in various applications on Ethereum. Solana only has 13 billion, right? So less than 10% of the economic activity of Ethereum. Binance Smart Chain has 20 billion. Terra has 10 billion. So there's a lot of competitors that in totality equal about 30% of the smart contract dollars at risk right now, but nothing has come close to Ethereum yet. So we're still in a show me story. The reason these investments have done so well is not necessarily because there's been traction yet, but because this is still a very venture capital dominated industry, right? What are VCs good at? They're good at looking at the future. They're good at looking at total addressable market. They're good at saying, if this works, it's going to be a home run, regardless of probability of success. That's kind of where we are right now for these other chains. It's some of them are inevitably going to work. Maybe all of them will work, but there's not enough data right now to suggest that any of them have that high of a probability of success relative to Ethereum. Solana seems to be the front runner right now for a couple of reasons. One is they have the backing of Sam Bankman-Fried, who went from junior Jane Street quant analyst to basically leader of the free world in the last 4 years. Now
Amazing.
An amazing success story. But he's basically been personally underwriting Solana, which has given the market a lot of confidence. And two, it is something that developers seem to really care about, right? If you made your entire investment decision based on, let me go talk to 1 billion developers and they tell me where they want to work, most of them right now will say they're trying to build on Solana. So those are two real reasons to invest in Solana. It doesn't necessarily mean it's going to work. But most people in the digital asset ecosystem do believe that we are heading towards a multi-chain world where you'll have Ethereum, you'll have Solana, you'll have Terra Luna, you'll have Algorand, you'll have all these different chains, and most likely they'll host different types of applications at first, and then eventually it'll be fairly homogenous, and you won't even know, which ultimate blockchain you're working on. I know this wasn't the question though, but I'll move on to, I mentioned two types of digital assets there. I mentioned cryptocurrencies and I mentioned smart contract protocols. The other two types of digital assets are asset-backed tokens, which is basically going to be bigger than all of them combined one day, right? Asset-backed tokens are just tokens that are backed by equity, debt, real estate, income streams, et cetera. That's a very small market today, but it's going to grow very fast.
For sure.
And then you have pass-through tokens, right? These are the hybrid loyalty, hybrid equity type tokens that I mentioned before, where by owning the token, you're getting some benefit like a reward for using the platform, but you're also getting some economic interest in the form of dividends or revenue pass-throughs of some sort. There's a tremendous amount of digital assets that fit that pass-through token right now that are basically just real companies, right? They might have a CEO, they might even have equity and debt in their capital structure as well, but they have a token that is basically bootstrapping the growth and the usage of their company. And that is growing tremendously fast. And that's where DeFi fits. That's where sports and gaming fits. That's where NFTs fit. That's where Web 3.0 fits. So there's a lot of different types of digital assets here that maybe haven't grown as much from an investing standpoint yet as the layer one blockchains like Ethereum and Solana, but they have a tremendous amount of opportunity as well if you do your research and you know how to find good managers, good products, good cash flow and revenue tokens.
I'm going to name a couple. It seems like it's what the audience wants. And maybe from an investing perspective, whether it's one word, 10 seconds, but probably not more than 30 to 60 seconds, because we have a lot to cover. You actually already mentioned a couple of them. One that I'm impressed by is Terra Luna. Don't know if it's going to be a winner or make it, although it's already relatively pretty big. And I know, they're going through some issues here, at least with in the US, but what's your opinion of Terra Luna?
Sure. So Terra Luna, again, we're sticking to our taxonomy here. Terra Luna would be a smart contract platform. It looks and feels similar to Ethereum in the sense that it is something that was built to allow others to build upon it. What the difference between Luna and by the way, just anytime we're mentioning any of these smart contract platforms, they're all trying to solve for the trilemma. The trilemma of every smart contract platform is speed, security, and decentralization. It's impossible to be the best at all three, which means every time if you focus more on speed, you're probably going to give up decentralization. If you focus on security, you're going to give up some speed. So all of them are just solving for some combination of those three. And for example, Ethereum is very decentralized and has high security, but therefore it has low transaction speed. Solana has incredibly high speeds, but very poor decentralization. And so you're making a trade-off whenever you use these. What Terra Luna did, which was interesting though, is they built the entire blockchain around the creation of a stablecoin called UST, which is a decentralized stablecoin. And basically the way it works, there's a lot of videos, it's fairly complex, but essentially the more stablecoins that get used in the ecosystem, the more Terra Luna that gets burned and is taken out of circulation. So effectively, if they can build up the growth of the stablecoin, then Luna becomes a depreciating asset or basically an amortizing asset, and that's why it goes up in price. So they've built this ecosystem around the growth of a stablecoin, which is different than how other blockchains have worked, where they just say, whatever stablecoin exists, you can use it on our blockchain. Luna just said, we're going to create our own and we're going to make the entire thing basically deflationary as long as the stablecoin works. And UST has a $6 billion market cap right now. So it's starting to grow as well, just like USDC and Tether. What Luna just launched, basically live to new developers. And now, just like everything else, there's going to be a lot of applications that are starting to get built on Terra Luna. So it's a similar version to things we've already seen, but they're tackling it in a slightly different way. So from my standpoint as an investor, I'm not really a venture capital investor. I'm not very good at looking 10 years out. I'm very good at looking at what exists today. So I like to look at traction today. I like to look at revenues and cash flows today. I like to look at applications today. To me, Terra Luna is more exciting than Solana just because it has more applications built on it that seem to actually work and function. Solana might be a better investment because if it works, it could be bigger, but it has a lower probability of success. So it really does depend on your investment risk reward and really the way you think of yourself as an investor in terms of what you want to get involved in. But they all have merit for different reasons. And I think Luna is incredibly powerful in terms of the way they constructed the blockchain and the token.
Completely agree. Although we may have differences on other aspects relative from an investing perspective or from a smart contract perspective, I think you have to kind of tip your hat at what Terra Luna is looking to do. There are some people that feel that Phantom, that would fall into the realm of what we're talking about so far, could be, let's go with next year's Solana, meaning perhaps it could really take off. Why or why not? Your opinion?
Sure. Yeah, I actually don't know as much about Phantom in the sense that, again, a lot of these early stage blockchains and protocols get a lot of investment dollars, and therefore they encourage a lot of developers to build applications, but there actually hasn't been enough built on Phantom yet to get my team excited. What we generally do, and we actually did the math on this, in the summer of 2020, Ethereum got to about a $25 billion market cap and a 10 billion TVL. Basically means it was just starting to grow, right? And compare that to today when, a year and a half later, Ethereum has a $400 billion market cap and 150 billion of TVL, right? So it's basically grown 10x in just a year and a half. But when that happened, when it hit that kind of critical point of about 25 billion market cap and 10 billion of TVL, That's when DeFi and NFTs took off. That's when the application layer took off. And you were actually better off, almost to the tune of 7x, to basically invest in DeFi tokens and NFTs than you were to invest in the Ethereum blockchain itself. We're sort of in the same place right now. When I mentioned those numbers a minute ago, Binance 20 billion of TVL, Solana 13 billion of TVL, Terra Luna 10 billion TVL, Avalanche 8 billion of TVL, Phantom 5 billion of TVL, and they all have market caps in that $5 to $20 billion range as well, with Solana being a little higher, closer to 40 billion. Right now, in order for any of these blockchains to work, you have to have some applications built on them that people use. So we are 100% shifting our attention right now at Arca into the applications that are being built on these blockchains and away from the blockchains themselves. We've all made a lot of money on the blockchains. The blockchains can almost be thought of as a lazy man's ETF. Like if you just want exposure to the growth of the asset class, you buy these layer one blockchains, and then eventually something has to be created. Like the iOS App Store itself would not be very valuable if it wasn't for Angry Birds and the Bank of America app and all these other things that were built upon it, right? That's where we are right now, is that these things were great early ways to get exposure, predominantly for venture capital like investors. But now the proof has to be in the pudding. At some point, there has to be usable applications built upon these for it to have success. And with Phantom, like I said, I just personally don't know that much about it yet, because there actually hasn't been much built on it yet that I can sink my teeth into. But because we have a front row seat at Arca, when that starts to happen, we'll see it, and we'll start to adapt our strategy to take advantage of that growing ecosystem as well.
Yeah, I mean, we could go on for hours and hours, because I know the knowledge base of the audience is going to be all over the place. We could have dove deeper into centralization versus decentralization, layer one, layer two, layer three, the Lightning Network and Bitcoin. Again, everyone, I see some of the comments and questions coming in. I do have to keep it about 90 minutes, not 4 hours. And this is going to be more of a broader discussion. We'll have Jeff back and maybe do a deeper dive on one or two specific things in the near future. One question that did come in from, I guess he must be Anon, Primal Key, is it relates to a question I had upcoming. So I'm going to look at that question. I'm going to ask it. On the subject of decentralization, based on the Nakamoto coefficient, Solana, and this shocked me too, I agreed with you, is the most decentralized by far the layer ones. I don't know if you want to go, we don't want to make it too technical and bore the audience of the Nakamoto coefficient, and whether most people as investors care if it's decentralized or not. That being said, did you have a comment?
Yeah, I mean, I have a comment by dodging the question. And the reason being is, look, I was a healthcare investor for a long time. I wasn't trained as a doctor. I traded autos for a long time. I wasn't trained as a mechanic. You don't have to understand every nuance of the code and every nuance of why something was built to understand whether or not it's going to work, right? Most people would tell you that Betamax was better technology than VHS, right? Most people would tell you that Blu-ray won because of their partnerships, not because of their technology. In most cases, what we're seeing, I mean, most people would even tell you that Bitcoin as a technology is not the best in terms of proof of work and the way it was designed, but it has a marketing and business development edge that is beyond probably anything that any other competitor will ever take over. We just don't when we first started Arca, we had a lot of developers on staff. We were like, okay, we got to understand the code. And we realized really quickly, it just didn't matter. The code has nothing to do with the success of these projects. It has to do a little bit with whether or not developers are willing to build on it, right? It has to work. But it's the same way of like, if you were a Netflix investor, how deep do you get into Netflix's algorithms to see if they work? You don't. You just at some point trust that they work. And, when you log into Netflix, you're going to see the shows and movies you care about. And until there's proof that it doesn't work, you're going to assume that it does. And we're at the same point now in digital assets. These are, we're getting to the point now where they've been around long enough that they work. And you can now track the user growth, the sentiment on Twitter, the feedback from customers on whether or not they like the product, the revenues and the cash flows. And it doesn't really matter anymore about a lot of the stuff that this industry was built on.
I'm going to I'll try to keep it short, a little bit of a shameless plug. And another topic that we could have dove into, but again, I don't want to make it too technical, is the difference between proof of work and proof of stake. But all these things, layer one, layer two, layer three, Lightning Network on Bitcoin, understanding the nuances, a proof of work, proof of stake, how to create an NFT. We didn't even get into that yet. These are things that we dive very deeply into at my core organization, family office association, through a consultancy that I have that we do that really walk investors and family offices very, very hands-on through really the full process. It is a lot to take in. But I think like what Jeff said and what I said earlier about the principle on the 1 or 2%, sometimes you do need to make a decision on limited information and then adapt as you go along. If you keep on waiting till your knowledge is perfect in this community, that is never going to happen. You're actually going to be overwhelmed by what's coming at you and probably get into paralysis and not do anything. And the person who doesn't maybe have that IQ, doesn't think about things so technically, that's probably the one taking action and making money. Okay, enough about that. I am going to mention, so my philosophy on investing, and I'm going to use broadly the terminology cryptocurrencies, is I follow a little bit of what's called a 70-20-10. 70% I anchor in some of the things we spoke about so far. 20% I go, let's call it mid cap. But I do have to bring up 10%, I do go for moonshots. I don't care about its underlying true usage or application. I look at various factors, adoption and growth, and it strictly is an investing perspective. I'm going to mention a couple. You could chuckle, laugh, or throw it out. It's all good. Shiba Inu being one.
So Shiba is, in my opinion, not something that any institutional investor would look at because, again, there's no way to value the token from any sort of traditional cash flow standpoint, any sort of traditional metrics. A Shiba would be in that cryptocurrency category, which is it doesn't really have intrinsic value. Its worth is basically just based on whether or not people enjoy using it and sending it and being a part of the community. Most people
big community, I might add.
A very big community. We've heard of the idea of meme stocks and meme coins, right? Like something like a GameStop or an AMC that obviously at this point is not trading anything close to its intrinsic value or its cash flow value. But there's a community of people who really want to be a part of it. This is where if you're an equity investor, you believe in Graham and Dodd. If you're a bond investor, you've probably read Frank Fabozzi, right? These are frameworks from 50 years ago for Fabozzi and 80 years ago for Graham and Dodd that basically every equity and debt investor believe in right now. When you're in the digital asset world, we just haven't figured out what those frameworks are yet. And it doesn't mean
throw that out.
Well, it doesn't mean things don't have value. It means that there is a disagreement on what that value is. The value to something like for Shibu, for someone like me, is zero. I'm not part of the community. I don't care about it. I have other tokens like stable coins and Bitcoin and other things that I can send perfectly well, but I'm not a member of the community. Someone who's in the community might value that much higher. They like the chats that they're in. They like the feeling of owning something that is, a unique and part of this small group, and that might be worth way more. So you have to just develop a different understanding of what it is you own and why you own it. For me as an investor, I tend to focus on the things that I can value. Therefore, Shiba is not interesting. For you, you might say, hey, I like the community. There's clearly growth. There's people talking about it. I can check Google Trends. I can check Twitter sentiment. And this is something that may be worth zero one day, but there's a lot more people out there who don't own it yet than people who do. And maybe they want to join that community and be part of it one day.
No doubt about it. I am going to give some comments. So Zero Hedge is a popular Twitter. I'm probably going to mess it up a little bit, and this will be hard for people to wrap their arms around. I get it. But Shiba Inu launched approximately actually about a year ago. Since its launch to, I think, yesterday, $1,000 invested in Shiba would be worth, are you ready? This is going to be crazy, 460 million. Maybe that's wrong data, but I looked at it at several different sources. And again, the numbers could be a little off. No one could have predicted that. It's crazy how the community grew. Here's another thing I'll say, a little sad for someone my age, but I have a collection of crypto shirts. I get very little comments wearing Bitcoin and Ethereum and even Solana shirts. I get stopped all the time by those under 25, I'll admit that, when I wear a Shiba or a Doge shirt, and I mean this a little seriously, I'm not even looking to make a joke out of it. It means that audience treats this as a very strong center, a part of their community. Now, they're not a friendly relationship, Doge and Shiba. We won't bore people and get into that. What I am saying is one person that stopped me, basically as a teenager, turned, I don't know what it was, 2 or 3 thousand into six figures. So they're going to be very loyal to Shiba, but I think they took some chips off the table, probably a good thing. Uh, Jeff, in general, as you become a figurehead in the community and you guys are looking at hiring young people, and you have like whatever nieces, nephews, do you have stories like that of people like out of nowhere, 18, 19, 20 years old that have actually done pretty good on some of this?
Yeah, I mean, there's definitely a real wealth effect. I mean, our CEO's executive assistant might be the richest person in our company, just for getting in early on a couple of coins. And sometimes you can say you had a real investment thesis. Sometimes it's just, I threw a little bit of money at something I heard about and it worked out well. There's a fine line between genius and luck. But what I would say is, again, each individual investor is going to have different things they care about. Like I said, I prefer revenues and cash flows and tangible value. Like we were an early investor in Axie Infinity. Axie Infinity is the first ever blockchain-based game. They do roughly $3 billion in revenue right now. They've got they have well over $1 billion in their treasury now as a 1-year-old game, and they trade at 3 times price to sales. We've made 140x on that position. That's been a home run, but we had a real reason for investing in that. You could have made the exact same return on something like Cardano or something like Shiba or something like Dogecoin that, in my opinion, can't be valued and has had no actual commercial success. But I'm not going to dismiss it just because I'm not investing in it, right? Again, it has more value to someone else than it does to me. I'm not going to dismiss it. I've learned to be incredibly open-minded. I'm just not going to invest in it personally. And I think what you're seeing now is a lot of the people who are in this space, it doesn't really matter how they got in, whether they got in from Bitcoin or Ethereum or Shiba or Cardano or Solana, whatever. Something is getting them in. And when they're in and they actually make a fair amount of money, they become loyalists, right? They really become passionate about what they're being a part of, what their community is, and all these things. And that sucks you in for life. And as a result, when we think about hiring, we started Arca 4 years ago. We had no money. We raised a small friends and family round. We had a little couple $1 million of assets in our funds. Every single person we hired was saying, I love this space so much. I want to work in this space. I don't care about the pay. Now I'm getting mercenaries every day, right? I get resumes from Citi and JP Morgan and Goldman and Blackstone and BlackRock and Bridgewater every single day, right? They're mercenaries. The first thing I ask them when they interview, I say, hey, what MetaMask do you have a MetaMask wallet and what apps do you use? And if their answer is I don't have a MetaMask wallet and all they're doing is trade, I don't even finish the interview, because I don't need to hire financial mercenaries right now. I want to hire the passionate people who live and breathe this stuff. I mean,
Absolutely.
one of the best kids on our team, he was a chemistry major. His parents were yelling at him for not pursuing that and coming to Arca instead. He was our intern. He literally doesn't even have a brokerage account. He doesn't care. His entire world is digital assets. Smart guy, chemistry major, incredibly talented, but this is his passion. And he wants to invest 100% of his assets in digital assets. He wants to spend 100% of his time in digital assets. That's the type of people we're looking for right now. And it doesn't mean people can't cross over. It's just that, we are lucky that we are now in probably the hottest industry at the right time. And we have our pick of the litter, and we gravitate towards people who want to be here, not people who are looking to make money. And they're not mutually exclusive. But again, you have to show some level of passion and interest, because this is a 24/7 job.
Boy, that segues into my next question so well. And again, I hope those that may be a little more on the fence and this is coming at them and, being a little bit protective in terms of all of this, understanding the importance of actually my next question and how it ties into what you said. From what you're seeing, are the brightest young minds, 18 through 25, in finance and engineering, are they all, I don't mean that figuratively, are they all going into crypto, digital, probably truly DeFi, where through open source work on many protocols, they could even individually do very well? It feels like they're all going into it.
I think they're all going into it in some level, right? Again, there's a very difference between being a passive investor on Coinbase of a token and casually following a Twitter handle versus being a power user in a DeFi application and getting your hands dirty and farming and maybe voting in governance forums. So there's definitely a spectrum here. It's not black and white. But there is no doubt that there are people who are diving headfirst in. But I wouldn't even say it's just 18 to 25-year-olds. I mean, one of the most talented people at Arca is a 38-year-old ex-KPMG cross-border M&A analyst who spent 12 years in a cubicle wearing a suit. He has a JD and a CFA. You know what he does every day now? He comes in a t-shirt, he wears a bandana, and he is using every single DeFi application you can find to test these out and figure out which ones work and which ones don't.
Yeah, that's awesome.
And he's awesome. I mean, he loves it. He spends every minute thinking about it. He's made a ton of friends in the community. So it's not necessarily the demographic, but it's definitely the passion. And I would say, yeah, first of all, money is a great equalizer, right? When you do something and you get rewarded for doing it, you're probably going to spend more time in it. So because people have gotten stupid rich in the space, it definitely turns them into power users and evangelists. But I also think that in some ways, it just makes more sense to a lot of younger people. I think it's crazy. For example, I'll give you an example. One of my neighbors is a really big real estate investor. He got a call on a Saturday about a hot property in Hawaii. And he looked at me and he goes, "Well, this is pointless." And I said, "Why?" He said, "Well, I don't have any cash right now, so I got to wait till Monday to sell some Tesla stock and Facebook stock. Then I have to wait till that clears T+1. Then I have to wait to send that to my bank account T+1. Then I have to send a wire. And by the time I put a bid on this property, it's going to be Thursday and it's going to be too late." And I was like, "Well, you recognize that if you had all of your assets in digital form, you could probably have that done in 10 minutes on a Saturday." So a lot of people, that just makes more sense to. They're like, why would I ever own cash? Cash is pointless. It inflates 2% or more every year. It doesn't have that much utility anyway, because nobody actually spends physical cash anymore. The bank accounts are a pain in the ass. Why don't I just have 100% investment all the time, and I'll use my investments to make payments? Intuitively, that makes a lot of sense. I would much rather own my Tesla equity as a digital token that I could send to pay for dinner if I needed to. I'd much rather own the equity in my home as a digital asset where I could fractionalize it and take 10% of it off if I need to go buy something for my parents, right? It just intuitively makes more sense. And I think when you start to think of it that way, that we're heading towards a world where nobody ever owns cash ever again. They're all 100% invested at all time. First of all, the stablecoin argument goes away because you won't need stablecoins. It'll be 100% invested at all times, and you'll use your investments as payment. Second of all, it's a much better world. Why sit with all this idle cash that does nothing just in case one day you buy a house or in case one day you have a medical problem and you have to spend it? Like, no, just be fully invested and be liquid at the same time.
I have a fair number of people that are live, and I'm looking at their names, and I know they're early stage with their interest in digital assets. Most of them have some level of exposure to Bitcoin, and often it stops there, maybe a little bit of Ethereum. And we hinted at these things earlier. I do have a question that I'm going to skip over, but so the audience thinks I didn't forget about it. I just don't think it's a great subject for Jeff in the limited 17 minutes that we have left, and that would have been on the Bitcoin ETF. But I am going to ask some Bitcoin questions that I think are a little bit more intriguing. So someone texted me and said, if you think that the digital asset ecosystem is going to go up, whatever, 50 to 100x over 10 years, won't I get that exposure just staying in Bitcoin? And I'll throw up staying in Bitcoin, Ethereum. And he might even add, how about public exposure like Marathon, like MicroStrategy, like Coinbase? Mm-hmm. I think that's a fair question. Why do they need to diversify and not stay concentrated?
Well, so here's the real answer. The real answer is these assets just have nothing to do with each other anymore, right? If you said to me, "Hey, yes. If you say to me, "Hey, I love ETFs, and I'm going to buy the first ever ETF that ever was created, and it was a gold ETF," and then you just say, "Yeah, I'm an ETF investor," but you just didn't invest in healthcare ETFs or bond ETFs or long or actively managed ETFs, you can't really say you're an ETF investor. At some point, you just say, "I'm a gold investor." Right? The ETF itself doesn't matter. The ETF was just the wrapper to give you exposure to a variety of different things. In some ways, that's what digital assets are as well, right? If you wanted to own the first two digital assets, which is essentially Bitcoin and Ethereum for all intents and purposes, that's fine. You have two very singular bets, right? Ethereum is a bet on the Ethereum ecosystem, which is the iOS App Store. Bitcoin is a bet on digital gold or store of value. Most of the passive indexes that have been created to date, like the Bloomberg Galaxy Index or the Bitwise Index, those are 80 to 90% Bitcoin and Ethereum. Those are not representative of the market. I mean, our main fund has outperformed the Bloomberg Galaxy Index by 10,000 basis points in less than 3 years. It's just not representative of the market anymore. You're making two very singular bets on two very singular parts of what digital assets represent. So if you want to say, I want exposure to the entire asset class, then I would say absolutely not. You're not getting it with those two assets. If you're saying those are two assets that I like and I believe in and I understand, then knock yourself out. But like all parts of investing, you just have to understand what it is you actually own, right? If you owned a technology index and then just pretended that social media didn't exist and Netflix didn't exist and Amazon didn't exist, you're probably not really getting exposure to technology. You're getting exposure to a few pieces of the puzzle that at one point were in the technology index. So basically, the long story short is just know what you own, and don't assume what you own is representative of the entire market.
100%. In 10 years, will Bitcoin still be the number one, let me broadly use the term, cryptocurrency by market cap?
I think it'll be the number one cryptocurrency. I don't think it'll be the number one digital asset. I think there is very little, and again, I've been investing for 20 plus years. You know how many gold conversations I've had over those 20 years? I'm saying maybe 5 at most. Like most people just don't care. Bitcoin is an incredibly interesting asset, and it's, in my opinion, it's a very binary option, right? It's either going to be worth $1 million per coin one day, and it actually becomes a real global currency, or it's probably going to be close to zero. And everything in between that is really just a path function based on the probabilities of hitting one of those two extremes. I own up a lot of Bitcoin personally. I think it will be actually used as a medium exchange. Mm-hmm. But to think that that's going to be bigger than Ethereum or Solana, or to think that that's going to be bigger than an Amazon tokenized equity, or to think it's going to be bigger than I don't know, like what if there's something that is representative of all of the governments and municipalities in the world and the taxation of those economies. Like, I'm just not myopic enough to believe that something that exists today and is bigger necessarily will be the biggest in the future. I think it'll be the biggest cryptocurrency in that category for sure. I don't think anything will compete with Bitcoin in that category, but I don't think it'll be the biggest digital asset.
And I'm glad you mentioned earlier, because only Plan B, who many people that are Bitcoin maximalists especially will know, ever admitted. Most people say energy consumption, regulatory, in terms of what's a risk to Bitcoin, at least from a price perspective. Completely agree with you. It's the Satoshi, he or she, a group of people kind of being exposed. And there's a couple of reasons why for that. One, who knows? Kidnapping, manipulation, government control, a loss of faith that now that person is known and we'll learn everything we need to know about them, the good and bad. Suppose they move the first 50 block, whatever. That would really be bad. And Plan B, it's not easy to get him to say negative things about Bitcoin. That was one where he admitted he hopes never happens.
Yeah. Well, don't forget, I mean, going back to your point about kids getting rich off this stuff, everybody who's a Bitcoin maximalist has had their lives changed because of Bitcoin. But by definition, you're going to be incredibly loyal to that brand and to that power and to that name. So I don't necessarily, I mean, Bitcoin, to me, anything, maximalist anything, regardless if it's Bitcoin or anything else, to me is silly because it just means you're being closed-minded. But regardless, like, there's a reason that these Bitcoin maximalists exist. Like, they have had life-changing amounts of wealth and power as a result of the singular asset, and therefore they, like most religions, they go and spread that gospel. But again, like most religions, it is faith-based, and it is a confidence-based. And if something pops that confidence, you could see a world where Bitcoin loses that lead. I think it'll be very difficult just because of the way information travels these days, and because of just the global nature of communities and networks. But it's not a zero probability, certainly.
For sure, and I completely agree. If I had the foresight, and great for them, in the early days, the first 4 to 5 years, to get involved in Bitcoin, and I'm up 1,000 or 2,000x. Absolutely, I completely understand. Now, looking from my perspective, I think I would diversify and be open-minded, but I understand why you would inherently feel that way. It was probably life-changing for you, and kudos to you. You won on something that I didn't. Good for you. Here's something I would like to discuss. The industry doesn't like when I bring it up, and I think it's very fair. We've had this discussion offline. If you go by, because the industry in the past has somewhat tied into Bitcoin, I'm sure you'll admit that, but if we go by Bitcoin halving cycles, potentially, in my opinion, some of the risk over Tether and stable coins, arguably still not perfect clarity on regulation. Are we in a bubble? If I go by history, we are going to have more than just an up and down. That happens to everything. We're going to have what we call in the community a crypto winter. That's a really, really bad bear market. And I mean really bad. In theory, that looks like it may pop up sometime, perhaps the second half of next year. Do you think Like historically, that's been the case every 4 years. That's going to happen again, or why not this time?
I mean, it's really hard to use historical data for anything in this asset class because it is so young and so new, and more importantly, because it's evolving so much, right? Each of the 4 year cycles that quote unquote exist had a completely different mix of assets than what exists today. I mean, most of the most heavily used, most profitable companies and projects didn't even exist 4 years ago or 8 years ago. So, right off the bat, I'm a little hesitant to put any real high probabilities on past events repeating. But more importantly, I'll put it this way: everyone's now familiar with Archegos Capital and obviously what happened to Bill Wang's
Bill
family.
Wong, of course.
Yeah. Um, if you actually look at the assets that Archegos owned, they didn't have historical high correlations. They were very different, right? There's no real a reason why Viacom would perform anything in line with how Tencent or other equities that they owned would perform. But when one investor was selling all of them at once because they were getting margin called, all of a sudden the correlation went to one of those underlying equities, even though, again, historically there was no high correlation. So what that tells you is that a lot of times correlations have to do more with who owns it than what is actually being owned. And the reason I bring that up is 4 years ago and 8 years ago, it was basically one type of investor who owned all of the digital assets, right? If you owned Bitcoin and Ethereum, you were the same type of person and you owned it on the same exchange.
Mhm.
Well, fast forward today, you have hundreds of different exchanges. You have hundreds of different countries involved. You have hundreds of different types of investors. You have macro investors, long short equity investors. You have individuals in South Africa and Brazil. You have gamers. You have technologists. You have economists. Like you have countries now getting involved, right? You have central banks getting involved. The diversification of the investor base is arguably more important than the investments themselves. And as a result, the correlations have been going down between digital assets pretty much every day for the last 3 years. And it's going to continue to go down because the investor base is different, because the assets are different. And as a result, it's really hard to see a scenario where they're all going to go down at once for an extended period of time. You might see short-lived things where they go down because of market makers bringing everything down at once, or because of leveraged liquidations and things like that. But longer term, it'd be the equivalent of saying, well, all ETFs go down at the same time. And the answer would be, well, that's ridiculous, right? Bond ETFs will probably go up while equity ETFs go down, right? Gold ETFs will probably go up while real estate ETFs go down. We're in the same vicinity now in digital assets, where these different instruments and these different investor bases are going to act differently, and it's going to create a natural smoothing of the volatility.
I hope so. I mean, even in with Bitcoin relative to Musk and China back in late May, I mean, that took a big hit of 50%, but relatively a couple of months later, it bounced back. So I could be hopeful. That being said, if I believe that potentially a big downturn could happen, and I'm just going by past history, in theory, there may be three things I could do with my portfolio. One, I could look at it as I'm in it for 5 or 10 years. I ain't going nowhere. If anything, I'll buy more when it goes down. So I stay long and I look at it over a 5 or 10 year window. Option number two, I try to think I'm really smart. I'm going to time the market. I'm going to get out. I'm going to cash in some chips, pay taxes, and I'm going to get back in at, of course, the perfect time. Option number three is I probably stay more long term, but I look to maybe do some shorting and hedging to mitigate my risk. There may be an option four, you tell me. But what do you think someone should do? I'm probably more of a fan of option one.
I think, as always, it is based on your education and your how much time and energy you're going to put into it, right? For instance, when I was on the debt and equity side for over a decade, I was a really good stock investor. I had a lot of good inside tips on industries and information that was coming through. People would pick up the phone and talk to me. As soon as I went to fintech, I lost all of my public equity edge. I wasn't the same investor as I was. I became a worse equity investor because of just the seat that I was in. Similarly, investors and prospects and LPs ask us all the time, "Hey, is now a good time to invest in digital assets?" And I say it's always a good time, because the faster you get it out of your hands and put it in my hands, the better. Because you're not going to be able to time things as well as I can, because I have a 12-person team dedicating 24/7 coverage to the entire growth of this ecosystem. And by definition, you're not going to have that, right? Timing it is very difficult regardless. What I will say, though, is even though I just spent a whole 5 minutes talking about how correlations are going down, what's really interesting about this asset class is it's actually the best asset class for active management that we've ever seen, because the assets are incredibly uncorrelated on the way up, where you can actually get differentiated returns based on research and understanding of the market. But it's very highly correlated on the way down, because you still have market makers that are pushing everything lower at the same time on low volumes when the market goes lower. So as a result, Bitcoin and Ethereum puts, where Bitcoin and Ethereum have actually become pretty liquid derivatives markets, buying puts to hedge your book on Bitcoin and Ethereum actually have really good results. When you look at Arca funds specifically, in the biggest drawdown months in the last 3.5 years, we've outperformed tremendously because we own cash and because we have puts. And that might not work forever, right? As the market dynamic changes and as the market continues to evolve, our hedging strategy will have to evolve as well. But there are ways to take out some of that volatility on the downside if it's caused by broad-based, regulatory headlines or leveraged liquidations and things like that. So that, there's definitely ways that you can take out some of that volatility.
I would say, Jeff, I have about 3 core questions left. We're pretty close to 12:30. Would you have an extra to 12:40, about 12, 13 minutes?
Sure.
Let's do it. And this could be the positive, because we sometimes went a little negative today. Institutions, massive amounts of money, sovereign wealth, pensions, endowments, etc. Very careful, still thinking about it, and probably the ESG issue and regulatory clarity are probably the big 1-2 punch that have not allowed a good amount of them to jump in, even at 50 to 100 basis points. This is inevitably going to change. You hear Mr. Wonderful talk about it. You hear others talk about it. Do you think in the next 12 months, we'll start to see more institutional dollars come in? And will that blow this up even more?
Oh, for sure. It's already happening. I used to run debt and equity money, and it wasn't uncommon for a new allocator to spend 18 to 24 months doing due diligence before investing. And that's when they already knew the funds, the product, the service providers, the ecosystem. Everything in digital assets is brand new. The funds are new, the strategies are new, the investments are new, the service providers are new. It's taking 3 to 5 years to do that due diligence. But guess what? Most of that started 3 to 5 years ago. So they're getting closer. And they're starting to allocate, and it's not just coming into Bitcoin. We're starting to see direct investments into DeFi and into NFTs and gaming. A lot of the money has historically come into venture because, for the most part, right or wrong, people view venture as not having mark to market and therefore not having risk, and they're less likely to go into something volatile because of the mark to market. But the reality is, in a lot of times, there's much more value in the liquid markets if you can understand that volatility is not a bad thing when it comes with upside volatility as well. So, but they're coming. I mean, the endowments, the sovereign wealth, the pensions. I mean, we are having conversations with them every day, and they are much further along than you'd expect.
And we don't really have time to get into it, but we hinted earlier relative to stable coins. There's tremendous opportunities for ownership of specific Bitcoin, Ethereum, and others, where lending it is going to earn a relatively attractive, let's call it 3 or 4% interest. Again, in today's world, that's amazing. Stable coins, the opportunity is probably through the roof. It probably is closer to 7 or 8%. We could do a whole program dedicated to that, and how there's lots of money from families and institutions that are basically net of inflation, underwater. And there's opportunities in this ecosystem, but maybe I will cue it up a little bit. I know we have Tasha coming on later, where it'll be most of our dedication. Give me a minute or two explaining to the audience that may not know too much. Of course, is going to be hard to do. DeFi, staking, yield farming. Did you want to wrap that up and try to cover it in 2 minutes?
Sure. I think I can probably do it in 2 minutes. So first of all, Arca actually just launched about 6 months ago the first ever digital yield fund, where it's a market neutral fund focused just on the yield generation in this asset class. We're targeting 10 to 20% annualized returns with very little market beta, very little volatility, and thus far we've been successful. The important thing about yield generation in the space is understanding where it comes from, and it comes from 2 places. The first is because we already mentioned the traditional banking and brokerage world is still incredibly siloed from the digital asset world, which means that even though there's trillions of dollars sloshing around in the traditional world, where you have reverse repo at $1.5 trillion every week, and you have 19 trillion of negative yielding debt, it's still hard to get that money into the digital asset world and out. And as a result, what happens is you have a very working capital starved industry in digital assets. The market makers need capital in order to make markets across various exchanges. The lenders and borrowers need capital in order to run their business. The people in emerging economies need dollar-based assets. So there is a whole problem with working capital. And as a result, if you're the one with capital, like our Arca Digital Yield Fund or anybody willing to lend, you get paid a lot of money for providing that balance sheet. The second reason yield exists is because of rewards, right? We talked earlier about how digital assets are the greatest incentive and coordination instrument we've ever seen. Well, what these early companies and projects are doing is they're basically rewarding you for being an early customer. If you want to be an early lender to a quasi bank in DeFi, you're going to get inflationary rewards for doing so. They're going to give you some of their tokens. If you want to be a balance sheet provider as a market maker, they're going to give you rewards. If you want to be an early tester of a game, they're going to give you rewards. These rewards are another way of saying you're earning yield. So those two things right there at a very high level, and yes, we'd have to go much deeper to understand exactly what yield farming is. But ultimately, all you're doing is you're being paid for providing your balance sheet and your time. And that's 100% of what DeFi is. And if you put those two together, you can create a pretty good strategy just earning yield without taking the market directional risk.
And another one that will, could be 12 hours on that we'll give 2 minutes to. I think people in my community, in the family office world, are gravely, and I mean gravely, capital bold, underlined, underestimating NFTs. First of all, a year ago, 99.9% never heard of it. The fact that now probably 90% of people have heard of it says something in and of itself. But they probably still think of it as being it's digital art. Oh, and by the way, if that's all it was, that could still be really impressive. Mm-hmm. They underestimate, and you kind of hinted at it with the tokenization of everything earlier, that, I mean, everything from membership organizations to clubs to being anon to avatars to interacting with the metaverse, something we don't have time to get into today. If you could explain how NFTs will be utterly massive, I think it's gravely underestimated by people.
Sure. And to start,
unless you disagree.
No, I 100% agree. And actually, Arca is in the process of launching an NFT fund as well to meet that demand. But NFTs are non-fungible tokens. Essentially, it's just another way of saying something that's scarce, right? Something that's one of one or one of 10,000 or something that is, not going to be fully fungible, meaning if you own a Bitcoin and I own a Bitcoin, it doesn't matter which Bitcoin we own, it's the same thing. But if you own an NFT and I own an NFT, they're largely going to be different instruments. It starts with art and collectibles because that's the easiest for people to grasp, right? If you've ever collected baseball cards or if you've ever, seen kids fight over a toy, you can see that there is scarcity value in something that not everybody can have, and therefore it can go up in value. But there's a lot of different use cases for NFTs as well. Music royalties can be an NFT. The equity in your house could be an NFT. Your data could be an NFT, right? What if you ever tried to go to two different doctors in different networks and they have no recollection of who you are because they have completely different information? Well, you can now own your own health records as an NFT and you can release it to the doctors when you go rather than them having separate information on you.
Exactly.
So the idea of data and effectively just storage of information or assets through an NFT is going to be incredibly powerful and transcend much more areas of this world than just art and collectibles. But more importantly, it's important to understand, why do art and collectibles even have value, right? They have value because you are owning something that is unique. You can display it, you can transfer it, and you ultimately, believe that others will assign a higher value to it. The only difference between what's happening in the NFT world and what's happened in the traditional world forever is that it's much easier to actually see these things, and it's much easier to transact them. Instead of a painting in your house that 12 people a year see that you have to go to a Sotheby's auction to then transact with, now you have something that can be your Twitter profile that millions of people see every day, and that you can send in 5 seconds on an exchange if you decide that you want to sell it to someone else. So you're really just taking forms of assets, scarce assets that we've known forever, and you're just digitizing them the same way we've digitized everything. And whether we like it or not, this is now an online world, and COVID accelerated that, but we were heading in that direction anyway. You get a lot more value out of things that you can display online than you do things that you can display in person.
For sure. And I mean, things like Cool Cats, CryptoPunks, Bored Ape Yacht Clubs, for some of my audience, they're probably like, what the hell is Angelo talking about? I mean, these have amazingly, probably especially CryptoPunks, really have taken off over the last couple of years and have created tremendous amounts of of interest, community, and yes, I guess you could say digital scarcity, aka its price is going up and up in value. Uh, Two quick hits, very unrelated. One of my friends did remind me, Angelo, don't forget to mention to Jeff on Shiba, we're back to that again, that it does have a swap program, and that is true, and has been dropping NFTs. So among that community of the people that really, really believe in it, and it's a hell of a big community, they're actually doing some interesting things. Whether it's going to work out long term, who the hell knows? But I felt I at least needed to bring that up. The other thing,
Well, I would just
completely,
I'd add to that real quick. That's the fake it till you make it economy, which is not. I don't even use that as a negative connotation. Like Shiba created a community first, and now is creating product second.
right.
Most of what we've done historically in society is you create a product first and build the community around it. This is just a new world that we're living in, right? If you create something that literally is nothing and it's just fun and people get behind it, and all of a sudden people make money on it, and all of a sudden there's millions and millions of people using it, well, now you can build whatever you want on it. Right? If I have millions of people who come to the same corner every day for whatever reason, I can build a store on that corner. That's effectively what Shiba is doing.
I got a comment question based on something random that you said, Jeff, but I do see among our live attendees, Emily, if you could ask the question via the chat feature, we may have time to put it in, so please do so. You brought up a name that I've gotten in trouble with doing podcasts about this, and boy, random on digital assets, and that is Bill Wong. So given your background in trading, this has been a little bit of some of my comments is, I mean, the guy came from nothing, was a successful hedge fund manager, kudos to him, took his money and dedicated it into his own family office and took a massive amount of money. Let's call it, I don't know, was it $250 million, 250 million? And within 8 or 9 years to 30x that with that amount of money, not in digital assets, that's amazing. I mean, that really, we could argue various points of it, but strictly from a trader's perspective, did you find that impressive, Jeff?
15 years ago, Jeff would have found it impressive. Old 42-year-old risk manager Jeff finds it less impressive. There's always going to be outliers on the upside and the downside of people who can make a fortune or lose a fortune, or in Bill Wong's case, do both at the same time. But what I found is I start to believe a lot of what Howard Marks says, which is you never want to be in the top 5% because the same risks that it takes to be in the top 5% are the same that put you in the bottom 5%. And ultimately, what I've learned is it's not about what you own or how much you believe in it. It's really, are you sized correctly? And for me, as a risk manager, whether it's with digital assets or equities or debt or anything, ultimately, I like to size opportunities based on the risk reward. And ultimately, if you are creating that much wealth that fast, or if you are destroying that much wealth that fast, the first question you have to ask is, were you sized correctly? And I don't know all the details around what Bill Wong did, but for me personally, I spend a tremendous amount of time understanding the downside of what we're investing in, and the upside will come if we're right. But I want to understand the downside more than I care about what the upside is.
And Jeff Dorman, for those that would like to learn more about Arca, let's assume they're whatever qualified purchasers. Tell us a little bit about the fund and how people could learn more about it. Is it a website, a URL they could go to?
Sure, and thanks for the opportunity. You can find me personally at jdorman81 on Twitter. Or Jeff Dorman on LinkedIn. Our funds, ar.ca is our website. We have a huge educational resource library there, including the ESG white paper that we discussed, and we do a lot of writing and webinars and educational materials for those trying to learn. Across the funds, we have a variety of different fund products. We have the Digital Assets Fund, which is our flagship core hedge fund, which is a long biased directional research focused fund. We have our Digital Yield Fund, which again is a market neutral fund looking to exploit some of the inefficiencies in the market related to yield opportunities. We have an early stage venture fund. We are launching an NFT fund. And then we also have some regulated products as well. We invented the first ever blockchain transferred fund, or BTF, which is basically a 1940 Act ETF-like structure, only the shares trade as blockchain-based instruments, as Ethereum-based tokens. So a lot of different products you can find on the Arca website, and we encourage you to reach out.
Jeff, it's been great. I highly recommend following Jeff on Twitter. It's been really a great follow. So I highly recommend that. And definitely for those that would qualify, I think what Jeff's doing in Arca is really very unique, very interesting. They've been highly successful at it. And maybe it's something you want to reach out and learn more about. Everyone, in my conclusion, I'm Angelo Robles, the host of the Angelo Robles podcast and the founder at Family Office Association. As you could probably tell with my excitement today, having Jeff on, I'm extremely active in the digital asset ecosystem. And again, this is really all the last 15, 16 months, and really mainly the last 9 or 10 months. If I could do it, you could do it. There's lots of opportunities to learn, and we do have some tremendous resources for our members, and sometimes through various master classes and private consulting that we do, mainly for family office level investors, really understanding this ecosystem. And it's complex. I mean, I went through the process of how do you create an NFT, actually doing it, actually minting it, learning how to use, you mentioned Metaswap and Uniswap, MetaMask and Uniswap and all that. It's not as hard as it may sound, but you probably need a little bit of hand-holding in terms of accelerating your knowledge, so arguably you make less mistakes. So feel free to reach out. The website is familyofficeassociation.com. I'm also moderately active on Twitter at Family Office, so an easy name to remember, and very active on YouTube, where simply we're also at Family Office there. We have a lot of resources, learn more about what we're doing, and reach out to me. I'm always happy to listen and learn from many people. There's many that know more than me, and it's an opportunity for me to learn from them. You could reach out to us or me directly if you wanted via email. It's angelo@familyofficeassociation.com. Thank you all for your time, our live audience, those that will watch and listen to this in a recording. And Jeff Dorman, you were very generous with your time. I appreciate it.
Great. Appreciate
Good
it.
to see you
Thanks for having
again.
me.
Thanks so much. Bye-bye.